All right, let's talk about QQQI. It's an ETF that's been making some serious waves, and it's all because of its massive payout. But the big question on everyone's mind is this for real? Is that income stream sustainable, or is there some kind of hidden catch we should know about? Let's dig in and find out.
So first things first, let's just look at the number that's got everyone talking. We're looking at a distribution rate that's been hanging out right around 14%. Yeah, 14. For anyone who's focused on income, that's just a huge, eye-popping figure. I mean, it's the kind of number that makes you stop everything and just go, wait, what?
Which brings us right back to that question. Is it just too good to be true? I mean, think about it. How does an ETF based on the NASDAQ 100, the home of high-growth tech, spit out an income stream like this? So what we're going to do is peel back all the layers here. We'll figure out if this is some brilliant next-level strategy or if there's a really big trade-off that you absolutely have to know about before you even think about jumping in.
Okay, so to really get our heads around QQQI, the author uses this fantastic analogy. Picture a two-engine plane. Both engines are absolutely critical and they have to work together perfectly to get this thing off the ground. One gives you growth, the other gives you that massive payout we were just talking about.
So what are these two engines exactly? Well, engine A is pretty straightforward. It's basically just holding all the stocks in the NASDAQ 100. This is your growth engine, right? It's powered by all the big names, Apple, Microsoft, NVIDIA, you know the drill. But engine B, well, that's where the real magic happens. This is an options overlay. And what that means is it's constantly selling options to generate a steady stream of cash.
Now, this isn't just your standard covered call strategy. QQI does something a little more sophisticated called a call spread. Here's a simple way to think about it. They sell an option to get cash in the door right away. That's your income. But, and this is the key part, they don't want to miss out if the market totally rips higher. So they also buy another, cheaper option at a higher price. This puts a ceiling on your gains, but not a hard wall. It lets you capture some of the upside. It's a really delicate balancing act, between income today and growth tomorrow.
Okay, so now we know how it works, mechanically speaking. But this brings us to what's probably the most important part of this whole thing. What's the real price of that income? What are you, as the investor, actually giving up to get that big monthly check?
And here's where it gets really, really clear. The distribution rate, that's the cash that hits your account, is that big 14%. But look at this. The SEC 30-day yield, which is the actual dividends from the stocks themselves, it's a tiny 0.08%. That's basically nothing. So the big takeaway here, this is not traditional income like you'd get from a bond or a high dividend stock. Almost every single penny of that payout is coming from that options engine we talked about.
This table really lays out the trade-off perfectly. Let's walk through it. Say the market just takes off like a rocket. Well, you'll still get your monthly check, which is nice, but your overall growth is going to lag way behind the plain old index because, remember, your upside is capped. Now, the sweet spot for a fund like this, a sideways, choppy market. That's where you just sit back and collect those juicy option premiums without feeling like you're missing out. And what if the market tanks? Well, that income gives you a little bit of a cushion, but let's be real. You're still going to feel the pain from the underlying stocks going down.
The author really hits the nail on the head with this quote. You're selling uncertainty to buy cash flow. That's it, right there. You are literally making a bet. You're giving up the potential for those huge, unpredictable gains down the road in exchange for a much more certain, predictable paycheck today. That is the core bargain you are making with QQQI.
So, okay, that's the trade-off. But that brings us to the real heart of the author's argument. Why hit the pause button on QQQ right now? Well, it all boils down to one thing. The feeling that the very market conditions that made this strategy shine might be starting to change.
And here are the three main headwinds they're worried about. First, volatility is drifting lower. And look, lower volatility just means lower option premiums. That's the fuel for QQQI's income engine, so less fuel means less power. Second, let's be honest, the mega-cap tech stocks driving this thing are already trading at sky-high valuations. There's not a lot of room for error there. And third, if this AI-fueled rally really keeps going, then the cost of having your gains capped gets a whole lot bigger. You'll be leaving a ton of money on the table.
And then you've got the fees. QQI isn't cheap. It charges 0.68% a year for all this active management. Compare that to a basic NASDAQ 100 tracker like QQQM, which is just 0.15%. That extra 0.5% might not sound like much, but it's a pretty big hurdle that the options strategy has to clear year after year after year just to break even with a simple buy and hold fund.
Oh, and we can't forget about concentration risk.
I mean, this whole fund is built on the NASDAQ 100, which means its fate is tied to just a handful of giant companies. If Nvidia, Microsoft, and Apple all catch a cold at the same time, well, both of your engines, the growth one and the income one, could just stall out.
Okay, so we've thrown a lot of information at you. With all that in mind, how in the world do you decide if QQIE is right for your portfolio? Well, this is where we shift gears a bit, from just explaining the fund to giving you a practical toolkit you can use to make a smart call.
It really boils down to asking yourself 3 simple questions. First, what problem am I actually trying to solve here? If you're in retirement and you just need that steady cash flow every month to pay the bills, hey, QQI was practically built for you. But if your goal is to get the absolute maximum long-term growth, you're probably giving up too much. Second question, what's your gut feeling on the market? If you think we're in for a nice calm rally, the case for this gets a lot weaker. And finally, and don't forget this one, what's the after-tax reality? These payouts are often taxed as regular income, which can take a big bite out of your returns.
So, all of this leads to the author's final verdict. For any new money, they're downgrading QQQI to pause or neutral. Now, if you already own it, it can still make sense as part of a bigger diversified income plan. But for anyone thinking of buying in today, the suggestion is to maybe look at alternatives, like just a simple combo of a cheap NASDAQ fund plus some good bonds. That way, you keep more control and you don't cap your potential upside.
And this last quote really ties it all together perfectly. Look, QQQI has done well. It's delivered on what it promised. But investing is never about looking in the rearview mirror. It's always about the next 12 to 24 months. And the market conditions that made this a slam dunk choice last year just might not be the same conditions we see this year.
Which leaves us with one final, very powerful question you need to ask yourself. With a strategy like this one, are you being a savvy income investor, or are you just buying today's cash flow with tomorrow's growth? The right answer is going to be different for every single person, but now, at least it's a trade-off you understand completely.